Hey, I'm Isaac Rose from Finance As You Grow. I specialize in helping first home buyers explore every pathway to home ownership, including options most brokers never mention. Today, I'm explaining guarantor loans. This is a strategy that allows you to buy a property with little or no deposit by using equity from a family member's property, usually your parents. It can save you tens of thousands of dollars and help you buy years sooner, but it needs to be structured properly. Let me break down exactly how it works, how to release the guarantor later, and what the risks are. A guarantor loan is structured where a family member, usually a parent, uses the equity in their own property as additional security for your home loan. Instead of giving you cash for a deposit, they offer part of their property as security. This reduces the lender's risk, which means you can borrow more and you don't have to pay lender's mortgage insurance or LMI. Here's the important part. You are still responsible for making all the repayments. The guarantor is not repaying your mortgage. They're not giving you money. They're just allowing the lender to use part of their property as security in case you can't make the repayments. Let me explain how this is structured. A typical guarantor loan uses what's called an 80-20 split plus costs. This means your loan is split into two separate applications. Application 1 covers 80% of your property value and is secured by your property only. Application 2 covers the remaining loan amount, which is usually 20% plus costs up to a maximum of 70% of the property value. This second application is secured by both your and your guarantor's property. Now, the guarantor property can only be used up to a certain limit. The total lending on the guarantor's property, including existing loans they have, must not exceed 70% of the property value. So, if your parents have a $500,000 property and they still owe $200,000 on it, the lender will calculate how much additional security can be taken from that property. In this example, the guarantor has $150,000 in available equity that can be used as a security. That's enough to help you buy a property without needing a deposit. So, let me give you a real scenario. Say you want to buy a $600,000 property, but you only have $30,000 saved. Normally, you need $120,000 for a 20% deposit, or you'd have to pay lender's mortgage insurance if you borrow more than 80%. But with a guarantor loan, your parents use part of their property as a security for the portion of the loan you can't cover. You buy the property with your $30,000, avoid paying LMI, and you're a homeowner. Now, here's the good news. The guarantor doesn't stay on your loan forever. Once you've built enough equity in your property, you can request to have the guarantor released. Typically, once your loan to value ratio or LVR is reduced to 80% or less, you can request the release of the guarantor. This usually requires a new valuation to confirm your property value, and the request is subject to an updated credit assessment. If everything checks out, your guarantor is removed and your parents' property is no longer used as security. This can happen in a few years if your property increases in value or if you make extra repayments and pay down your loan faster. Once you release, it's just your property securing the loan. Now, let's talk about the risks, because this is important. If you take out a guarantor loan and you miss payments, the guarantor becomes legally responsible for your debt. If you can't make your repayments, the lender can pursue the guarantor for the guaranteed portion of the loan. In extreme circumstances, the lender can sell the guarantor's property to recover the debt. It can also potentially impact the guarantor's credit report. This is why guarantor loans need to be structured properly and why the borrower needs to be confident they can make the repayments. It's not a decision to take lightly, because it does involve risks for your parents or whoever is acting as guarantor. That said, when it's done correctly, a guarantor loan can be one of the most powerful ways for a first home buyer to get into the market sooner without needing a huge deposit. We've helped clients buy properties with as little as $15,000 to $20,000 saved using a guarantor structure. Here's the key takeaway. A guarantor loan allows you to buy with little or no deposit by using equity from a family member's property. You avoid paying LMI, which can save you $20,000 to $40,000 or more. The guarantor can be released once you've built equity, but there are risks involved, so it needs to be structured properly and everyone involved needs to understand what they're agreeing to. If you're considering a guarantor loan, or if your parents have asked you about it, that's exactly what we assess in a strategy session. We look at your finances, your parents' equity, and we structure it in a way that protects everyone. We also show you the pathway to releasing the guarantor as quickly as possible. If this was helpful, save it and share it with someone who's thinking about using a guarantor. And if you have questions, drop them in the comments below. I'm Isaac from Finance As You Grow, and I help first home buyers and their families structure guarantor loans the right way. Thanks for watching.